Welcome back to our tax resolution series. I'm Nina, CPA based in Boise, Idaho. In this episode, we're diving into a flexible solution for taxpayers who can't pay their full tax debt, the Partial Payment Installment Agreement, or PPIA. If you're feeling overwhelmed by your tax bill, this could be a lifeline that you need. What is a PPA? Partial Payment Installment Agreement allows you to make manageable monthly payments to the IRS based on what you can afford, even if it doesn't cover the full amount of your tax debt. The remaining balance may eventually be forgiven, provided you meet all the terms of the agreement and the statute of limitations expires on your tax debt. How does PPIA work? Monthly payments. You make agreed upon payments towards your tax debt based on your financial situation. Remaining balance of any unpaid balances after the IRS collection statute expires, generally 10 years from the assessment date, may be forgiven. Periodic reviews. IRS will periodically review your financial status, and your payments could be adjusted if your circumstances change. Who qualifies for a PPA? You might qualify for a PPA if you owe more than IRS than you can reasonably pay, even over time left in the statute of limitations. To determine your eligibility, it's the same process as the CNC. You would need to complete 433A and 433F, which outlines your income, expenses, and assets. IRS will evaluate whether your financial situation justifies a partial payment agreement. How to set up a PPIA or Partial Payment Installment Agreement. Assess your finances, gather proof of your income, living expenses, and any assets you own. Submit the Form 433A or 433F. This provides the IRS with a detailed view of your financial picture. Then call the IRS and negotiate a payment term. Work with the IRS or through a tax professional to establish a monthly payment you can afford. Then the other portion is compliance. Stay compliant, keep up with the payments, file your future tax returns on time, and promptly pay any other taxes owed as they arise. Advantages of a PPIA. Affordable payments. Payments are based on your current ability to pay. You avoid collection actions, stops garnishment, liens, levies, while the agreement is active. Possible debt forgiveness. Any remaining balance after statute of limitations may be written off. Consideration. Financial disclosure. You will need to provide detailed financial information, including documentation of your income, expenses, and assets. IRS will provide ongoing reviews with your financial situation periodically, which could result in increased payments if your circumstances improve. It accrues interest and penalties. PPIA versus other IRS programs. A PPIA is an excellent option if you don't qualify for currently non-collectible status or an offer in compromise, but you still need more affordable solution. Unlike a full installment agreement, a PPIA acknowledges that you may never fully pay off your tax debt. Setting up a partial payment installment agreement can be a game changer for taxpayers struggling with overwhelming tax debt. If you are in this situation, don't hesitate to reach out to a professional guidance. I'm Nina here in Boise, Idaho, and I specialize in helping taxpayers find the right solution for their unique circumstances. Thank you for tuning in to episode 8 of our tax resolution series. If you found this episode helpful, please like, subscribe, and share it with someone who might benefit. In our next episode, we'll discuss the IRS Offer and Compromise Part 2, which allows you to settle debt for less. And unlike the first episode we did on the Offer and Compromise, this is going to be a little more detailed, and it's going to cover the business trust fund taxes as well. See you next time.